Nobody teaches you this in school, not in economics class, not in any personal finance book I've ever read, and I've read a lot of them. Here's what I want you to think about. In 2021, a bombshell report from ProPublica dropped. It showed that the 25 wealthiest Americans, people like Jeff Bezos, Elon Musk, Michael Bloomberg, paid a true tax rate of just 3.4% between 2014 and 2018. 3.4%. Meanwhile, a middle-class teacher or nurse is paying 22%, 25%, sometimes more. How is that even possible? The answer isn't some complicated offshore scheme. It's not illegal, and it's been sitting in plain sight for over 100 years. The strategy has a name. It's called buy, borrow, die. And once you understand it, you'll never look at wealth or taxes the same way again. Let's start with something basic. Most of us think about money the same way. You work, you get paid, you pay taxes, you spend what's left. Maybe you save a little. Maybe you invest in a 401k. And eventually, when you sell an asset, a stock, a piece of property, you pay capital gains tax on the profit. That's the game most people are playing. The ultra-wealthy play a completely different game. Here's the first piece. Buy. The rich don't accumulate wealth the way most people think. They're not sitting on giant piles of cash. What they hold are assets, stocks, real estate, business equity, art. These assets grow in value over time, and here's the critical part. As long as you never sell them, you never trigger a taxable event. The IRS can't tax you on money you haven't realized. That's the rule, and the wealthy figured out how to exploit that rule decades ago. Warren Buffett once said, and I'm paraphrasing, that his favorite holding period is forever. Everyone thought that was some philosophical wisdom about patience. It wasn't. That was a tax strategy. Now, here's the second piece. Borrow. If you're sitting on $500 million worth of stock and you never sell it, how do you actually live? How do you buy a yacht, pay for your houses, fund your lifestyle? You borrow. You go to a bank, and when you're worth hundreds of millions, banks are thrilled to lend to you, and you put up your stock portfolio as collateral. The bank gives you cash. You spend it. And here's the part that breaks your brain. That borrowed money? Not income. The IRS doesn't tax loans. So you've essentially turned an asset into spending money without triggering a single dollar of capital gains tax. In 2021, reporting from Bloomberg showed that Elon Musk had borrowed somewhere in the range of $61 billion against his Tesla shares over a multi-year period. $61 billion. That's enough to live several thousand lifetimes over. None of it taxable as income. Honestly, when I first read that, I sat there for a few minutes just staring. Because we're taught that the only way to access your wealth is to sell it. That's the story told to regular people. The actual story is completely different. The interest on those loans is often low, especially when borrowing rates are favorable. And in some cases, the asset growing in value outpaces the interest cost. So you're borrowing cheaply against something that keeps getting more valuable. The loan essentially pays for itself in appreciation. You're not losing money, you're quietly building more of it. Nobody's on TV explaining this to you. I find that strange. Now for the third piece, and this one is where it gets almost unbelievable. Die. Yes, the strategy literally depends on death. When you die, your assets transfer to your heirs, and because of something called the stepped-up basis, a provision in U.S. tax law that dates all the way back to the Revenue Act of 1921, the cost basis of those assets gets reset to the market value at the time of your death. Let me make that concrete. Say you bought Apple stock in 1998 for $10 a share. You held it your entire life. By the time you die, it's worth $200 a share. The $190 gain? Gone. Your heirs inherit the stock at $200. They turn around and sell it the next day. They owe zero capital gains tax on that $190 appreciation. 100 years of accumulated gains wiped clean. Legally. This has been legal since 1921, and the wealthy have structured their entire financial lives around it for generations. The Rockefeller family is probably the best example of this strategy working at full scale. John D. Rockefeller built Standard Oil into the most dominant corporation in American history, worth at its peak, by some estimates, roughly 2% of the entire U.S. GDP in 1913 money. That translates to somewhere around $400 billion in today's terms. He died in 1937. His descendants, 6 generations later, are still among the wealthiest families on the planet. Not because every generation was a genius with money, because they built a structure around assets that was almost impossible to tax. Trusts, family offices, strategic borrowing, and the stepped-up basis reset generation after generation, quietly resetting the clock on every capital gain that ever accumulated. Here's what nobody talks about. The Rockefeller method wasn't invented by a brilliant financial advisor. It wasn't taught in business school. It was discovered through decades of lawyers and accountants finding the seams in the tax code. And once it worked, it spread quietly through the upper class. Not as a book, not on an online course, as whispered advice passed from one family attorney to another behind closed doors. Now here's the angle I've genuinely never seen another video mention, and I think it matters. The Medici family of Florence, the Renaissance banking dynasty, were doing a version of this strategy in the 1400s. They accumulated assets. They lent money to kings and popes. They never cashed out their empire in the conventional sense. They used their accumulated wealth as collateral to build more power and fund more accumulation. When Cosimo de' Medici died in 1464, the family's wealth didn't vanish. It transferred. It compounded. It went on to fund Botticelli, Michelangelo, and eventually the entire cultural explosion we now call the Renaissance. The specific mechanism was different. There were no capital gains taxes in 15th century Florence, but the logic was identical. Hold assets, borrow against them, transfer them. Never realize, never trigger, never lose. Buy, borrow, die isn't a modern innovation. It's not something a Wall Street firm dreamed up. It's a pattern that powerful families have been running for 600 years. We just gave it a catchy name recently. I find that genuinely unsettling, actually. It suggests this isn't some accidental loophole. It's a fundamental truth about how capital works, one that's been kept mostly off the radar for ordinary people for a very, very long time. Let me be direct about something. I'm not here to tell you this is fair. It's not. A nurse earning $75,000 a year pays a higher percentage of her income in taxes than Jeff Bezos pays on his real-world wealth accumulation. That's not politics. That's math. You can read the ProPublica numbers yourself. They're public record. Go look. But knowing it's unfair doesn't help you build wealth. So let's talk about what actually applies to someone who isn't a billionaire. The core principle translates, even at a smaller scale. If you own a home that's appreciated significantly, you can borrow against it through a home equity line of credit, or HELOC. You don't sell, you don't trigger gains, you access liquidity. Same principle. If you hold a stock portfolio, firms like Fidelity, Schwab, and Interactive Brokers offer what are called portfolio margin loans or securities-backed lines of credit. You borrow against your holdings without selling. The rates are usually far lower than a credit card or a personal loan. This is buy, borrow without the dramatic die part, and it's available to regular investors right now. The stepped-up basis applies to your heirs too, not just billionaires. If you hold appreciated assets and leave them to your children, their cost basis resets at your death. This is estate planning 101, and most people have never heard of it. Now, a legitimate warning, and I'm not a financial advisor. This is education, not advice. There's a real difference. Borrowing against assets carries risk, serious risk. If your assets drop significantly in value, say a market crash hits, the bank can issue what's called a margin call. They can force you to sell assets at the worst possible time to cover the loan. This happened to investors who had borrowed too heavily against their portfolios during the 2008 financial crisis. It can wipe you out faster than almost anything else. The wealthy have massive buffers. They can absorb a 40% drop in asset value and still have plenty of collateral. Most people can't. So if you use this strategy, use it conservatively. Borrow a small fraction of what you can theoretically borrow. The downside is severe, and I'd be doing you a disservice not to say that plainly. There's one more piece to this that almost nobody brings up, and it's subtle. Liquidity. Real liquidity. Most people chase liquidity. They want cash. They want to feel like they have immediate access to their money. And the psychological discomfort of seeing wealth tied up in stocks or real estate makes them want to sell. So they do. They realize gains, they pay taxes, and in doing so, they quietly shrink their wealth every single time they do it. The wealthy are comfortable being illiquid on paper because they've built borrowing mechanisms that give them real-world cash flow without triggering a sale. Comfort with paper illiquidity is, in my opinion, one of the underrated psychological traits of people who build generational wealth. It doesn't get talked about, not as a concept, not as a mindset. You're taught to have an emergency fund, good advice, but you're not taught to think about borrowing against appreciating assets as a real alternative to selling them. That gap in financial education is enormous, and I think it's worth naming. So here's the picture, put together plainly. The ultra-wealthy buy assets, mostly equity in companies, real estate, sometimes commodities. They hold those assets and let them appreciate without selling. When they need cash, they borrow at low rates using the assets as collateral. The borrowed money is not taxable income. They service the interest through dividends, rental income, or further borrowing. When they die, the stepped-up basis resets everything. Their heirs inherit wealth without a capital gains bill. The cycle continues into the next generation. That's it. That's the whole thing. No secret society, no hidden handshake, just a structure that's been quietly working for a very long time and that the financial education system has never bothered to explain to ordinary people. I think about this a lot. Why isn't this taught? You can learn BODMAS in 5th grade, but nobody explains the stepped-up basis to a college student making their first investment. You can pass an economics class without ever hearing the phrase margin loan used in a practical context. The information isn't classified, it's just absent. My honest opinion, I don't think it's a conspiracy. I think it's simpler than that, and somehow more depressing. The people who design school curricula aren't wealthy enough to know this stuff personally, and the people who know it personally have no incentive to broadcast it. So it stays exactly where it's always been, in the conference room of a family lawyer's office, surrounded by people who can afford to be there, until someone talks about it online. Here we are. One final thing, and this is what I keep coming back to. Buy, borrow, die works because of inaction, not genius, not hustle, not a brilliant investment call. The core move is just not selling, sitting still, letting time pass, holding when every instinct says to cash out. In a culture that rewards action, celebrates hustle, and tells you to stay busy and move fast, the most powerful wealth strategy in existence is basically do nothing. I genuinely don't know what to make of that. Maybe it says something about how we built the tax system. Maybe it says something about wealth and patience. Maybe it says something about all of us, about the stories we're told about how hard work and merit are what separate the rich from everyone else. Maybe it's worth sitting with that for a while.